What if one decision could reshape global trade, tilt economies, and test the strength of alliances? On May 30th, President Donald Trump made a major announcement that did just that, doubling tariffs on imported steel and aluminum from 25% to 50%. Effective June 4th. He made the announcement while standing in front of steelworkers at U.S. Steel's Mon Valley Works in Pennsylvania, saying it would protect American jobs and strengthen domestic industry. Trump stated, "At 25%, they could still get over the fence, but at 50%, they can't." The timing of this move is not random. It aligns with a massive $14 billion investment by Japan's Nippon Steel into U.S. Steel, a deal Trump once opposed, but now says will keep U.S. Steel under American control. He promised no layoffs, no outsourcing, and announced that every worker would receive a $5,000 bonus. But on the same day, new economic reports revealed a surprise twist. Canada's economy, expected to slow, actually grew. Meanwhile, the U.S. economy, expected to expand, shrank. In Canada, import duty payments jumped by $396 million in the first quarter, up nearly 40%. This came after Canada imposed retaliatory tariffs on American goods in March, hitting steel, aluminum, and more. Prime Minister Mark Carney's plan estimates up to 20 billion Canadian dollars in tariff revenue this year to fund economic growth. Despite offering some exemptions, Finance Minister François-Philippe Champagne confirmed 70% of Canada's counter tariffs are still in place, covering goods worth over 40 billion Canadian dollars. Across the border, the picture looks different. In April, U.S. goods imports dropped sharply by nearly 20%, reaching just over $276 billion. This was the steepest monthly decline since 1992. The decline came after Trump's sweeping tariffs on April 2nd, known as Liberation Day, which added a 10% universal levy and higher duties on Chinese imports. This led to a huge drop in imports, shrinking the U.S. goods trade deficit by almost half to around $88 billion, the smallest gap since late 2023. But fewer imports also meant fewer options for consumers, and consumer spending slowed from nearly 1% in March to just 0.2% in April. The slowdown shows Americans are more cautious, facing price hikes and economic uncertainty. Canada, in contrast, had a solid start to 2025. Its economy grew at an annual rate of over 2% in the first quarter, higher than both forecasts and previous growth. This rise was powered by a burst in exports and companies stocking up, bracing for trade troubles with the U.S. Exports of passenger vehicles jumped over 16%, while machinery climbed 12%, as businesses rushed to ship goods before more tariffs took hold. But not all signs are positive. Canadian household spending growth slowed, especially on big items like cars, and the household saving rate dropped to its lowest level since early 2024. Real estate also cooled, with residential investment down nearly 3% and a steep decline in home resale costs. Business investment in non-residential structures dipped, though spending on machinery and tech rose by over 5%. The job market showed mixed signals. Wages increased in sectors like healthcare and construction, but fell in manufacturing and retail, areas more exposed to global trade. Corporate profits also slowed, hit by rising costs and uncertain forecasts. Still, financial markets reacted positively to the GDP numbers. The Canadian dollar strengthened, and bond yields edged higher, suggesting traders see less chance of a rate cut at the next Bank of Canada meeting. But even with a strong first quarter, the road ahead looks tougher. Manufacturing is already slipping, as U.S. tariffs start to weigh on cross-border trade. Forecasts show second quarter growth may slow to just 0.5%, well below Canada's long-term trend. The central bank, recognizing the uncertainty, skipped its usual forecasts and instead issued scenarios. In a mild case, with limited tariffs and ongoing uncertainty, growth could stall. In a severe case, where tariffs expand widely, Canada's economy could shrink by over 1%. Inflation remains stubborn, keeping the central bank cautious on cutting rates, though they may act later in the year if economic slack builds and inflation eases. In the U.S., the first quarter of 2025 marked the first contraction in 3 years. the economy shrank at an annualized rate of about 0.2%. This downturn was mainly due to a surge in imports early in the year, as companies and consumers rushed to buy before tariffs kicked in. The trade deficit grew, subtracting nearly 5 percentage points from GDP. Consumer spending, which drives about 70% of the US economy, also slowed to its weakest pace in 3 years. Households pulled back on non-essential items, and the personal saving rate rose to nearly 5%, the highest in a year. Businesses responded by ramping up investment, with capital spending rising over 24%, mostly in equipment and inventory. Government spending, on the other hand, fell by over 4%, the biggest drop in 3 years, as federal budget cuts and layoffs took hold. Corporate profits plunged by over $100 billion, reversing gains from the previous quarter, showing the strain from trade uncertainty and shifting policies. Inflation stayed near target, with the core PCE price index rising just 0.1% in April and 2.5% year-over-year. The Federal Reserve kept interest rates steady, balancing inflation control with signs of slowing growth. Meanwhile, Germany is adding fuel to the fire with a proposed 10% tax on US tech firms like Google and Meta. Culture Minister Wolfram Weimamer said his office is drafting the levy, aimed at ensuring these firms contribute more to German media and culture. The tax could follow Austria's model, but at double the rate, and help fund journalism. Talks with tech leaders are underway, as Germany hopes to find a compromise. But President Trump's administration sees digital taxes as unfair, and a new US law allows retaliation against countries that target American firms. Chancellor Friedrich Merz is expected to meet Trump soon, hoping to ease tensions. Still, German media groups back the tax, while industry groups warn it could worsen trade ties. Europe remains a huge market for American tech, with Meta earning over $38 billion from the continent in 2024, about a quarter of its global revenue. Google earned over $100 billion from Europe, the Middle East, and Africa, driven by search ads and YouTube. Google Cloud added $12 billion, thanks to AI expansion. Apple also saw strong results, bringing in over $100 billion from Europe alone, with high-margin services like the App Store and iCloud growing by over 13%. Amazon's European business, part of its international segment, made nearly $143 billion in 2024, with Germany and the UK as its largest country markets. But Europe is also getting tougher. The Digital Markets Act of March 2024 now classifies major tech companies as gatekeepers, subjecting them to strict rules and big fines. In April alone, the EU fined Apple and Meta €700 million for data violations, and Google faces a multi-billion euro fine. Still, Europe remains vital. Digital ad spending in the EU is expected to grow 8% annually through 2027. Big tech is responding by investing heavily in local infrastructure, data centers, and new privacy features. So, what does this all mean? For the US, steep tariffs may offer short-term trade benefits, but risk slowing the economy and hurting consumer confidence. Growth in the near term may hover between 1 and 1.5%, depending on trade talks and policy clarity. Long-term success depends on shifting to domestic production in areas like semiconductors, green energy, and advanced manufacturing. Canada has played its cards well so far, turning tariffs into government revenue and leveraging export strength. But sustaining momentum will require investing those gains wisely, upgrading infrastructure, training workers, and opening new markets through trade deals beyond the US. Europe, meanwhile, is walking a tightrope between regulation and cooperation. The proposed digital tax may trigger retaliation, but also sets the stage for a more balanced tech economy. With strong ad growth, digital sovereignty efforts, and green innovation, the EU could turn today's tensions into tomorrow's leverage. All three regions face hard choices. Protectionism brings short-term wins, but long-term risks. Only by blending strategy, dialogue, and investment can they build stronger, more resilient economies.